Agilence was launched way back in the day, called 2006. Russ came in 2008 and moved it from a hardware company servicing, call it the restaurant, retail, grocery industries, moved it into more of a SaaS play in 2013. And today is really vertically integrated into those three sectors, doing things like incident management, human capital management. That's what they're looking to expand. And they already do operational analytics, merchandising, et cetera. They're doing $35 million in ARR today, or right around there, up 17% year over year. The first $10 million year was 2018, first $1 million year, 2014. He's doing this in a capital efficient way, powered by the war chest that is the private equity firm Cordera Capital, as he looks to scale potentially inorganically with acquisitions moving forward. Hey folks, my guest today is Russ Hawkins. He's building Agilence. That's agilenceinc.com, which helps reduce, shrink, and improve margins across retailers, restaurant operators, and grocers to increase their margin by reducing preventable loss across the business. Russ, you ready to take us to the top?
Sure am.
Now, what are you, an ex-grocer? Did you own your own grocery chain before this, or what? How'd you learn about this problem?
No, not at all. No. Actually, I'm kind of a serial startup guy, but not a founder. I've been, in most cases, the first outside manager to come in working with the original founders. So this is my third company. Prior to that, I was 15 years with what came to be known as Lucent Technologies in the telecom business.
Of course. Now, this particular company, Agilence, give us the backstory. What year did it launch?
So the company was founded way back in 2006 and originally had a completely different approach and a completely different technology that we were using. I got recruited in around 2008 and basically changed the model of the company to be a recurring revenue model. And then in 2013, made a major pivot to strictly a data SaaS company, SaaS software company.
Sorry, what was it between 2008 and 2013 if it wasn't SaaS already?
So the company was originally in the loss prevention business, but it was about visually verifying suspect transactions. So the way the product was deployed was in a server, and we were largely focused on grocers at the time. So basically, the companies would use a printout or a file out of their POS system or their exception-based reporting system, and then they would turn to Agilence to visually verify. So a very video-centric company. The idea was to enable an analyst sitting in headquarters to be able to review transactions across a chain of grocery stores, essentially visually determining whether there was something amiss in those transactions. But it was a hardware-oriented business. I tried to make it a recurring model by providing...
Wait, Russ, hold on, that's a big deal. It started off as there was an upfront hardware installation required.
Originally, yeah.
Oh, wow, interesting. Okay, got it. And you came in and said, now, did you come in because, current investors weren't happy with the founders and they said, we got to bring in Russ, or how'd that happen?
Yeah, so my prior company was a high performance computing company, and my controller was married to a venture capitalist in the Philadelphia area. So I had gotten to know him, and when I sold that company successfully, he asked me if I would consider running one of his portfolio companies. I actually looked at 3 of them, and this was the one that I thought had the most interesting technology, and to me, it was a great technology with poor go-to-market and poor marketing, and so that's what attracted me there. It also was, the value was in the software, but it was delivered in a piece of hardware. We put servers out at each grocery store, essentially. Yep. Yeah.
I want to flesh out all the years between 2008 and 2013 and 2013 to 2023. But before we go fill that backstory, tease us a little bit with where you're at today. Give us a story of how a customer is currently using you here in 2023.
Yeah, so the major shift that we made in 2013 was to focus really more on data analytics and be less video-centric. We thought we could do a better job than what was being done in the marketplace at the time with a technology called exception-based reporting, which was being used by many large retailers. And right now we've proven that. We came out with a minimum viable product in 2013, and we've evolved pretty significantly since then. Originally, the use cases were all around loss prevention, but now 80% of my customers use it for operational analytics, merchandising, marketing, even the finance organizations use it for a variety of things. So today it's all about data management and making the data exhaust that all the systems that are operating in these businesses, we pull them all together and we create value or give the users the ability to create value out of all of that data.
Oh, what's going on there, YouTube? Good to see you guys. Now imagine this. You love watching these interviews with SaaS founders, but imagine if we took all of the valuation data out from over 2,807 interviews I've done manually. Saves you a lot of time. Well, we've done this. We've built it into the beautiful interface inside of FounderPath. Check this out. I'll show you how you can access this in a second, but you log in, you connect your Stripe account, you see your valuation real time, you can see what it changed over the past 88 days, and even set goals for valuation this year. Now, the secret to valuation is there's many different ways to value a SaaS business. So the reason you're going to see 3 or 4 different valuations inside of your FounderPath dashboard, this is all free by the way, is because depending on who's doing the buying of your SaaS company, you're going to get a different valuation. A VC is going to pay a different valuation. Private equity firm is different. If you're going to do a minority sale, that's different. And if you sell the whole business, that's a different valuation. You can see all those when I hover over here. Right, so the teal is what a VC would pay, yellow is what private equity, and red is if you sold the whole thing outright. Now, what's cool about this is not built off random data. Again, you guys hear these interviews on YouTube. All these data are built from real-time valuation data points founders share with us on the show. So traction, 1.2 million, seed round, 3.7 raise, they sold 22% of their business. Go in here and filter by the event. Maybe you only want to see companies that have sold the whole business. Well, here are a bunch that have been acquired, the valuation and the multiple. Maybe you're going out right now and you're raising your seed round. Well, go in here and look at all this recent seed deals that went down, what they raised, what valuation they raised at, and what percent that they sold. There's never been a larger data set of SaaS valuations than what you can get now inside of FounderPath, and we're thrilled to bring it to you. All right, we're going to go back to the YouTube video here in a second, but if you want to check this tool out, if you want to jump in and sign up, you can check it out for free to get your valuation at this link, founderpath.com/products/valuations. Or if you go to founderpath.com and hover over products, click on get your valuation here, and go ahead and sign up to give it a whirl. Again, all that valuation data live right inside the platform. I hope to see you there. All right, let's jump back into the interview. Russ, with that idea, the operational analytics, merchandising, organizing SKUs, all the data exhaust managed under your platform today, what's the average grocer going to pay you per month or per year to use your technology?
Well, it really depends on the size of the grocer and there's differences in the grocers versus retailers versus restaurants. So today we have a couple of hundred customers, more than a couple of hundred customers across those 3 groups in the U.S. On average, they pay us around $125,000 a year, but we have some that are close to $1 million and some that are smaller.
Interesting. Do you have anyone paying your biggest customer? Don't name them, obviously, but anyone paying more than $1 million per year all in?
No, we have 3 right close to that, but not nobody yet. Well, although most likely through expansion sales, all 3 of them will be over that threshold within the next year.
It's one of my favorite metrics when you read all the S1s from the SaaS companies going public is go down to the customer section buried on page 60 and see how many $1 million plus customers they have. That's always a nice metric to see if you have healthy net dollar retention, et cetera.
Yeah, originally we were focused more on the mid-market, and we kind of worked our way up to supporting larger companies, and along the way we've learned a lot. And now we're really considered the leader in this space.
Mm-hmm, mm-hmm. Just to put a sort of a tighter range on this, when you say a couple hundred customers today, we're talking like 400 or 500 or closer to 1,000.
No, we've got closer to 300, and
300. Okay.
They're across all 3 markets, but all in the U.S. Well, U.S. and Canada today. So we've avoided for now bringing the platform outside the U.S. Mainly because I've done that before, and I know it takes a lot of energy, and you really need to have patience to make that work. One of the things we're considering now We sold the company to a private equity firm about 18 months ago, and one of the things that they've enabled is potential acquisitions. And so I'm looking at a couple of acquisitions right now that would give us a structural platform to bring our solution to other geographies.
It's great to have someone like that behind you, especially in a world where valuations are tighter. You can maybe get better deals than you did a year ago. So let's talk more about that here in a second. I do want to try and get a general sort of size in the company. How many folks are full-time today at the business?
We're 70 people.
70. Okay. And how heavy on engineering? How many engineers?
About 27, 28.
Okay. 27, 28. And you must have a trained sales team if you've got accounts that are paying up towards $1 million. How many are CSMs or AEs or BDRs, et cetera?
So the sales organization today is around 10 folks.
Okay.
And that's a combination of bag carrying salespeople, BDRs, and we have technical leads, people that do solutions. They basically do architecture and those
solution selling. Yeah.
Solutions.
Interesting. Of the 10, how many are carrying the bag? Using your words, how many are quota carrying?
5 of them are bag carriers.
Interesting. How do you split up the deal flow? Is it geo based? Is it industry based? How do you split that up?
A little bit of both. So we make a delineation between retail and restaurants. The use cases are significantly different in restaurants, and even there's sub segments in there, right? In restaurants, there's quick service restaurants, but there's also table service restaurants. So the use cases can vary significantly. On the retail side, we have a segmentation around grocery, specialty, drugstores. Those are the three segments, and we're starting to do more with convenience stores now as well. But basically, we break it down. The salespeople are assigned. It's account assigned. So we spend our energy today with the largest accounts in terms of account executives, and then outside of the sales organization, we have a marketing team that looks to get people to self-identify in the mid range, and we do a little bit at the low end, but most of it is in mid range size companies.
Russ, can I ask you, for one of those 5 fully ramped AEs with a quota, what is that quota you want them to hit annually? Is it $1 million ARR?
Right around $1 million ARR, yeah.
Yeah. Interesting. Okay, very cool. All right, more on the backstory here, because you know when you look at actually the funding history of the business, you're actually fairly unique, and I say unique, it's a compliment. It looks like you've been very capital efficient because you've smartly used debt. You joined in 2008. I think only maybe $1 million had come into the company at that point, maybe a little more. But how have you thought about building the capital structure over the past 10 years, 15 years?
So we started with venture capital. I mentioned that we sold the company about 18 months ago. I think of that as kind of a graduation. We graduated from the venture world to the private equity world. But prior to that, we raised several rounds of venture capital and peppered in, put in debt also as we went along.
Russ, can you sum those just so people understand how you were thinking? What was the total equity in versus the total debt in the business?
So the debt varied. We paid things off and paid things down out of cash flow over time. But probably at the height of it is probably only $5 million in debt, and about just a little short of $30 million total equity raise.
Okay. So you still, one thing I always ask, especially operators like you coming in, you're managing a cap table, obviously. You're managing an ESOP pool for employees. I imagine, obviously, the founders own the majority before you came in 2008. How did you just make sure to keep good control of your cap table so there was always room for you to go recruit a great new revenue leader like you just did?
Well, you mentioned earlier about being capital efficient. So I'm a little bit different, I think, than some people running small startup companies in that I've always been very conservative. I don't like to get ahead of my skis in terms of hiring. Even though I am chasing growth, I try to keep a balance. And, I never want to be in a desperate situation where I have to raise money because I have to. So we've tried to take a very methodical approach over time, raising money really before we need it on an incremental basis. I made mistakes, people do, but we lately, so the last 18 months, we had more debt. We've leveraged up with debt because that's kind of the part of the PE playbook. And so the equity to debt ratio right now is about 60-40 in the plan, in the business.
Yeah. Okay, that's helpful to understand. I guess going back to the backstory here a little bit. So again, good use of debt, good use of equity. You then engage with Excel KKR, I believe, before before the deal with the private equity firm. Is that accurate?
It is. So I pitched AKKR at one point did the Silicon Valley Road
Yeah.
there and they remembered me, and actually AKKR decided to enter into the debt business, and I think I might have been the first deal that they did in the debt business. So I worked with
Was
them.
that out of their publicly traded BDC, the FSKKR BDC?
No, I don't believe so.
It was okay. So it was a private debt fund that they managed.
It was. Yep.
Interesting. Are you able to share, like a lot of founders don't even know that debt is an option. So anytime I get someone like you that is experienced, that's done it, I try and get as much information as possible. How do these debt deals work? What can you share?
Well, they changed over time. I mean, there's a wide kind of census of debt providers in there, and they're all over the place, from banks to private debt providers. Early on, we were paying fairly hefty rates, so they're getting good returns usually.
What's hefty, Russ? You're talking like 17,
low
18,
teens,
19?
low teens, low teens, and a little bit of equity in there as well. As
like 2 to 3% warrants.
Yeah, smaller actually in most cases.
Okay.
1 to 2 has been my experience.
Okay.
And as as our revenues have gotten more predictable, we're able to do better on the interest rates, and now we have basically a bank as the lead debt provider, and then they are subordinating it to some of the historical debt financing companies. They're not really banks. They're just more risky providers, I guess.
And who lined that facility up? Was it you or Quadrilla Capital?
Quadrilla, and yeah, they did this one, and they're pretty good at that. These guys are ex-Marlin guys for the most part.
So just to be clear, it was not a unitranche deal. There was an A piece and a B piece, and the A piece was like the PNC Bank, and the B piece was Hercules on top of that, something like that.
Something like that, yeah.
Okay, interesting. Yeah, guys, this is a huge model. No one talks about it, but it's a great way to preserve equity over time. So Russ is clearly doing that, which we love. Now, Russ, why was the right time to sell last year to Quadrilla Capital? What made it the right time?
It wasn't.
Or I guess it's 2021. 2021.
It wasn't the right time to sell. I don't think we should have sold, to be honest with you. But
why'd you do it then?
Because the investors and the owners of the business decided that they wanted to do it for their own reasons, which is a problem. It's a problem from my perspective with multiple venture investors that have conflicting objectives within their own funds. I think we sold the company short, to be honest. And
can I ask, Russ? I mean, when you say short, can you quantify that? Like that you sold, for example, like a 5 to 10x multiple, and you thought it should have been 15x, something like that?
That's right. It was more, well, maybe not 15x, but we sold sub 5, and I think we should have gotten more like 8.
Interesting. And the investors you had on the equity side just weren't being patient enough to wait it out.
Well, so they weren't all equal, right? The initial money that I raised back in 2008, that particular investor was very supportive and very, very interested in continuing to do what needed to get done. And then in subsequent rounds, we brought in additional voices and additional.
We got to give them credit, by the way, Russ. Anytime you say good things about VC, we got to give them credit. That was Granite and Next Stage back in 2008, correct?
So Next Stage was the original investor in the business before me. They're the guys that basically hired me, and then I brought Next Stage. I brought Granite in.
I see, but they're the ones you're giving credit for being patient, good, long-term, founder-friendly capital,
and supportive, and so forth. And then, the later people. One was a kind of a family office, had a different set of perspectives, and then the last one to join was the one that wanted to move more quickly in terms of an exit.
Fair enough. We won't put them on the spot here, but it's good to understand the patterns. Now, Russ, going back to
with them anyway, so I'd rather not mention.
Okay, well, I mean, was that Wellington? Are we talking about Wellington?
No. Wellington was a debt provider. So
we're talking about Arrowroot or Astor?
Arrowroot.
Okay, yeah. I'm very familiar with their capital structure, and you're right. It's a family office. They have a short-term fund life typically. Why didn't you surface some of these risks with their capital structure ahead of time before taking their money?
Because I guess I just blew it. I mean, I didn't do it. I misinterpreted what they were at the time, and they told a good story about what they were and what their hold period was and what they wanted to do. And maybe they just grew tired of the business. I don't really know. All I know is that they forced our hand, and it was not what we wanted to do.
All right, let's end with the last 2 minutes here looking forward. So the company today, you told us about 300 customers. You mentioned earlier, average ACV, something like 125K. Russ, is it appropriate to multiply those together to back into sort of your revenue range, or would that math not be accurate?
That's reasonably close.
Okay, so that would put you at about 37 million bucks of ARR today. Is that accurate?
A little bit less than that today.
Okay, and where were you 1 year ago so we can calculate growth rate?
The last year we grew at 17.3%.
Okay, got it. So you're at like something like 31 million ARR 1 year ago.
Something in that range, yeah.
Okay. So this is good, controlled growth. You mentioned inorganic growth with a private equity fund behind you today. What kind of acquisitions are you looking for?
Well, we're looking for adjacent technologies. We're all about data analytics, as I mentioned, primarily in the retail space. This is enterprise customers. My average customer has 600 locations, so we're not talking about small businesses here. I have an interest in a couple of different areas. I'm very, very interested in incident management and task management. I'm interested in frontline human capital management. In retail environments. We do some good things around e-com, but I'd like to get more real time. We're forensic in that we basically can tell you what happened up until yesterday. Okay. So I'm interested in going in that area. We've got some interest and already some use cases in the supply chain management, the distribution management. So there's some things in there. What else? On the restaurant side, that's a smaller part of our business. I think there's some interesting add-ons we could do in the restaurant tech area. So I think, and then one other thing would be that just general geography, picking up competitors that can give us a foothold in additional geographies. I've tried to do it on a greenfield basis, and it's just expensive and takes a long time. So I'd like to look at some of those things.
How do you manage concentration risk in terms of your concentration at Quadrilla? From what I can tell, they've only bought 3 companies. You're one of them, maybe one of the bigger ones, in addition to Chartbeat and Infodesk. Is there any risk for you being such a large position in their fund?
Well, I think they're pretty well funded, first of all, and I think they've got.
Is that public? How much have they raised?
That I don't know.
Okay.
Well, that I'm not. If I did know, I wouldn't be able to share it.
Fair enough.
But we were there. We were actually their first investment. They've been extremely supportive. I love these guys. They're doing a great job with me because they're transparent. They tell me what they want. We talk about it, and then I execute on it. And they're essentially investing in my vision of where I want to go here. So,
this is Jonah Sulek and Vikram Abraham, just to give them credit.
That's correct. Yep. Vic is the point on the deal, but Jonah and Vic work very closely together.
Marlin equity in their blood. That is the tree they came from. So good group of guys there. Now, what's the process, Russ? You find a great deal in the incident management space that you want to buy. Let's say it's doing $5 million in revenue. You have negotiated high level with the founder. You're going to pay a 2x multiple for $10 million, of which $8 million is cash up front, $2 million earn out in stock. What do you need from that group you're going to buy to take to Quadrilla to get the deal approved and unlock the capital?
It's a little more interactive and collaborative in terms of what we do. I've produced kind of a roadmap of acquisitions of directions that I want to go. My initial list of names, there's been some of them that fall into the category that you described, where I've developed a relationship with these companies, but there's a team of people. Quadrilla has a team of people that help me. They do outreach.
Oh, nice.
They do outreach and they help me. And then as far as the actual details of the acquisition, I'm primarily using their money. So the divisional labor is I come up with the strategic ideas and run the companies, and they work the details on the financing.
Interesting. Well, that makes a lot of sense. As we wrap up here, Russ, give us, we didn't get a lot of the backstory in terms of other revenue milestones. What year was your 10 million year? When did you pass 10 million?
That was I don't know, 6 years ago, 5 years ago, something like that.
Okay, so call it 2018. And what was your first $1 million year, if you remember?
Oh boy. Well, in the new platform, it was probably 2014. The older we stopped selling the older platform as soon as I made the pivot in 2013. But we had hit $1 million with that product back in 2009, I guess. Yeah, 2009.
All right, very good. Let's wrap up with the famous five. Quick answers. Number one, favorite book.
My favorite book.
Yep.
A Confederacy of Dunces by Toole.
Number two, is there a CEO you're following or studying?
No.
Number three, what's your favorite online tool for building Agilence?
My favorite online tool for building Agilence?
Yes.
Well, I got a lot of ones that I'm not happy with. Let's see. What are the ones?
Maybe that's a better question.
I guess I'd have to point to the Salesforce. I mean, it's our CRM, and we get a lot of value out of it.
I should start asking that question. What's the last software contract you turned from? You terminated.
In terms of what is it you're looking for?
I'm just joking. You're saying ones you're not happy with. I'm saying why should start
ones
asking.
I'm not happy with.
Yeah.
No, I'm not. Definitely not mentioning that.
Yeah.
I don't want to do that.
Number four, Russ. How many hours of sleep do you get every night?
About. I get 5 in two tranches, I guess.
All right, fair enough.
There's a trip to the bathroom in between.
What's your situation? Married, single, kids?
Married, 4 kids. Just had my first grandchild.
Oh, congratulations. That's so fun. How old are you, Russ?
I'm 64.
Last question. Something you wish you knew when you were 20.
Oh. How important the decisions that you're making every day are.
Guys, there you have it. Agilence was launched way back in the day, called 2006. Russ came in 2008 and moved it from a hardware company servicing, called the restaurant, retail, grocery industries, moved it into more of a SaaS play in 2013. And today is really vertically integrated into those 3 sectors, doing things like incident management, human capital management. That's what they're looking to expand in. They already do operational analytics, merchandising, etc. They're doing $35 million in ARR today, or right around there, up 17% year over year. Their first $10 million year was 2018, first $1 million year, 2014. He's doing this in a capital efficient way, powered by the war chest that is the private equity firm Cordera Capital, as he looks to scale potentially inorganically with acquisitions moving forward. Russ, thank you for taking us to the top.
All right. Well, thank you, Nathan.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers, they try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company, or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them, and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.